On September 15th, 2008, the largest bankruptcy in American history was filed before the markets opened. $639 billion in assets gone in a single morning.
Lehman Brothers staff arrived at work in London this morning to be told the bank had been put into administration.
In this morning's top corporate news, creditors of Lehman Brothers filed more than 16,000 claims before yesterday's deadline.
It was the worst day on Wall Street since the crash of 1987.
The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt.
I wake up every single night thinking, what could I have done differently? This is a pain that will stay with me for the rest of my life.
By that afternoon, the Dow Jones had dropped 4.5%, the biggest single-day fall since September 11th. Within weeks, global credit markets had frozen solid. Millions of people lost their jobs.
This is another classic case of city boys trying to make too much too fast.
Optimism at Lehman Brothers one day after the investment bank filed the biggest bankruptcy in U.S. history. And news Barclays is buying the bulk of the company.
A pivotal moment in the financial crisis. Letting Lehman's go under caused panic on the markets. Suddenly, no bank was safe.
Hold long before the dramatic collapse of Lehman Brothers last week.
Trillions of dollars in retirement savings vanished. The worst economic collapse since the Great Depression had begun. And it all traced back to one building on 7th Avenue in Manhattan. One firm, one man. His name was Richard Fuld, and for 14 years he had been the most feared man on Wall Street. Fuld grew up in New York in the 1950s. His family wasn't poor, but they weren't wealthy either. He was ambitious, competitive, with the kind of intensity that made people uncomfortable in a room. He enrolled at the University of Colorado, then set his sights on the Air Force. He made it into officer training, but it didn't last. One day, a senior cadet was bullying a younger recruit. Fuld stepped in. There was a fight. Fuld was out. He would spend the rest of his life carrying that same instinct. Protect your own, fight back hard, never back down. On a trading floor, that made him dangerous. Dangerous in a way that people paid attention to. In 1969, he walked into Lehman Brothers as a junior commercial paper trader. He was 23 years old. The firm was legendary, founded in 1850 by 3 German immigrant brothers who started by trading cotton in Alabama. By the time Fuld arrived, it was one of the most storied names on Wall Street. He was good. Then he was great. By the early 1980s, he was running the fixed income and equities divisions. Colleagues called him the Gorilla. Not as an insult, but as a badge. He was physically intimidating, ferociously competitive, and utterly relentless. He rose, and kept rising. Here's where things get interesting. By 1984, Lehman was in crisis. A vicious internal war between traders and investment bankers had nearly torn the firm apart. American Express swooped in and bought it. For a decade, Lehman wasn't really Lehman. It was a division inside a financial conglomerate, being slowly consumed from the inside. Then, in 1994, American Express spun it off. Lehman Brothers was independent again, and there was only one man anyone trusted to run it. Richard Fuld became CEO and chairman. He later described the night he got the call. He said he stopped breathing for 45 seconds. He had a full-blown anxiety attack. He didn't want the job, but he took it. He came in the next day, he said, with terrific resolve. What followed was one of the most remarkable turnarounds in Wall Street history. Fuld rebuilt the culture from scratch. He tied executive pay to the firm's stock price, making hundreds of people at Lehman genuine owners of the business. He pushed into investment banking. He diversified. He navigated the 1997 Asian financial crisis. He steered through the collapse of long-term capital management in 1998 without losing the firm. 14 consecutive years of profit. The stock up over 800% on his watch. By 2007, barons called him Mr. Wall Street. He had earned $500 million in compensation over his career. He was briefly, on paper, a billionaire. And then the thing he had spent his whole career fighting against, a force he couldn't intimidate, couldn't outmaneuver, couldn't win against in a hallway confrontation, came for him. The problem had been building for years, quietly, invisibly. In 1997, Lehman bought a Colorado mortgage lender called Aurora Loan Services, a company that specialized in loans made with minimal documentation. No proof of income, no verification, just a name and a signature. Then, in 2000, they bought BNC Mortgage, a California subprime lender, handing out loans to people who had no realistic chance of repaying them, on homes that were wildly overvalued. By 2006, these two subsidiaries were writing nearly $50 billion in mortgages every single month, and Lehman was keeping huge chunks of that debt on its own books. This is the part where you need to understand one number. In 2003, for every dollar Lehman had in actual capital, it had borrowed $24. By 2007, that number had climbed to $31. $31 of borrowed money for every $1 they actually owned. What that means in practice, if the value of their assets dropped by just 3%, just 3 cents on every dollar, the entire firm's equity would be wiped out. One of Lehman's own analysts wrote an internal note warning that the firm had effectively become a real estate hedge fund disguised as an investment bank. He was ignored. The chief risk officer tried to raise concerns in board meetings. According to Larry McDonald, a senior Lehman trader who later wrote a book about the collapse, Fuld had the risk officer removed from the boardroom during key discussions. Fuld had spent 38 years becoming the most powerful person in the room. He had never learned how to hear the word no. In 2007, the US housing market began to crack. Homeowners who had borrowed money they couldn't afford, on houses priced at levels that couldn't last, started defaulting. The securities built on those mortgages, the ones Lehman was holding by the hundreds of billions, began falling in value. And here's where things get truly dark. Lehman knew. The numbers were there. The losses were real. But instead of coming clean, they reached for a tool that had existed quietly in their playbook since 2001. They called it Repo 105. Here's how it worked. Every quarter, when Lehman had to file its public financial statements, the firm would secretly transfer up to $50 billion worth of bad assets off its books, essentially making them disappear. It would sell those assets to a shadow company, get cash in return, then quietly buy them all back a few days later. On paper, the debt was gone. The leverage ratios looked healthy. The firm looked stable. The accounting trick was so legally questionable that they couldn't find a single American law firm willing to approve it. They eventually found a British firm that signed off under British law and moved the transactions through their London office to make it work. The firm's own global controller later admitted there was no substance to the transactions. They existed purely to deceive. At the end of the fourth quarter of 2007, $39 billion moved off the books. First quarter 2008, $49 billion. Second quarter 2008, $50 billion. The auditor, Ernst & Young, knew and said nothing. When the bankruptcy examiner later asked Fuld about it, he said, "I have absolutely no recollection whatsoever of hearing anything about Repo 105 transactions while I was CEO." By March 2008, Bear Stearns had collapsed. The Fed bailed it out. JP Morgan absorbed it for pennies. Everyone on Wall Street looked at Lehman and thought, they're next. Potential buyers came. Warren Buffett's team reached out. The Korea Development Bank expressed interest. Bank of America circled. Barclays was in discussions. Each time, Fuld balked. The offers didn't reflect the value he believed Lehman was worth. He kept holding out for a better deal. He had spent 14 years being right about everything. He couldn't accept that this time the market's judgment was correct. In June 2008, his own senior bankers staged what amounted to a management coup, forcing him to demote his CFO and COO. Fuld remained CEO in name, but the real authority had shifted. He was still in the building, still in his office, still projecting the same ferocious confidence. but the firm was already dying around him. On September 10th, 2008, Lehman announced that its available cash, the liquidity that was supposed to be its safety net, was around $40 billion, but only $2 billion of it could actually be used. 5 days later, on September 15th, Lehman Brothers filed for Chapter 11 bankruptcy. 164 years of history ended overnight. The fallout was immediate and total. The Dow collapsed. Global credit markets froze. Banks stopped lending to each other. The phrase "too big to fail" entered everyday language. Governments around the world spent trillions of dollars trying to stop the bleeding. The recession that followed destroyed the savings, the jobs, and the futures of tens of millions of ordinary people who had never heard of Repo 105, who had never placed a single trade, who had never made a single decision that brought any of it about. A congressional committee later asked Fuld how he felt about what had happened. He said, "Until the day they put me in the ground, I will wonder why Lehman Brothers was the only firm that was allowed to fail." He never spent a day in jail. No senior Lehman executive was ever criminally prosecuted. He quietly moved into wealth management and kept working in finance. The boy who threw a punch to defend someone who couldn't defend themselves had become the man who couldn't see, or wouldn't see, that his own firm was doing the same thing to the rest of the world. He fought for Lehman until the very end. He just never fought against it.